This is ShadowQuant, Crypto Edition, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Thursday, July 23, 2026, and this is the New York session. Now, let's get into it. Bitcoin is sitting at $65,150, holding barely above the psychological threshold, as the broader crypto market contracts under a crushing 14 out of 100 on the Fear and Greed Index. We are looking at a liquidity vacuum where altcoins are being decimated, with Avalanche down more than 5% and Dogecoin shedding nearly 4.5% in 24 hours. This isn't just a dip, it is a structural unwind of leverage. Before we dissect the damage, let's look at what is driving the tape right now. The verified headlines paint a picture of intense friction between geopolitical instability and regulatory shifts. First, Cointelegraph reports Iranian crypto outflows spiking 700% following U.S.-Israeli airstrikes. Second, CoinDesk notes that the U.S. Senate housing bill includes a CBDC ban, introducing immediate legislative noise around digital currency frameworks. Third, PayPay, 40% owner of Binance Japan, is seeking up to $1.10 billion in a Nasdaq IPO, signaling massive institutional interest in exchange structures even as spot volumes cool. And finally, TD Securities identifies NYSE tokenization as an institutional turning point, though that narrative is currently being drowned out by the noise. Let me jump in on that sentiment data immediately, because the headline numbers are screaming caution. The Fear and Greed Index is at 14. That sounds low, which usually triggers contrary unbuys, but the 10-day trend is rising from 12 to 14. That means panic is accelerating. It's not bottoming, it's deepening. The market is trapped in a paralysis zone where every attempt to stabilize is getting sold into. The 700% spike in Iranian outflows isn't just background noise. It is injecting unstructured, high-risk liquidity into the system that exchanges are struggling to filter, creating a friction drag on all trading pairs.
And that friction is visible on the charts. If you look at Avalanche at $6.30, we are seeing a high probability breakdown into liquid zones. 5.2% drop on heavy volume is not a shakeout, it is a falling knife. The chart structure shows clear invalidation of lower timeframe support levels without any consolidation. Meanwhile, Dogecoin at 7 cents is exhibiting classic liquidation cascade behavior, no wicks. Just straight down. The volume confirmation across the board, $61.8 billion in total market volume, tells us this is a systemic repricing event, not a thin book anomaly.
I need to correct the narrative that this is purely a technical breakdown. The root cause is a collapse in Bitcoin futures demand, which has hit 2024 lows. Without leveraged participants, there is no institutional bid to absorb the spot sell pressure. We are seeing a pure flight to safety. Bitcoin dominance is expanding to 56.74%, while Ethereum dominance is contracting to 9.86%. Capital isn't rotating into alts. It is consolidating exclusively in the anchor asset, Bitcoin, which is acting as a liquidity sink rather than a leader.
So we have a perfect storm. Grid is flagging broken technical supports on Avalanche and Dogecoin, CIPHER is identifying the void left by collapsed futures demand, and Pulse is warning that the sentiment trajectory is still worsening. This confirms we are in a strict liquidity vacuum. The market is forced to discover lower prices simply because the derivative leverage required to hold prices up has vanished.
Let's drill down into the specific assets taking the hardest hits, starting with the biggest mover, Avalanche or Avalanche. Avalanche is trading at $6.30, down 5.2% in 24 hours. It has breached immediate structural support. What is happening on the tape?
Technically, Avalanche has left a wide gap of untested liquidity below the previous swing low. This is indicative of stop hunt activity. The aggressive volume expansion during the sell-off confirms that sellers are in control. There is no sign of absorption. Until we see sustained horizontal accumulation at this level, the path of least resistance is lower.
And that is because the flow data shows zero institutional commitment at these levels. The capital that was previously supporting high beta L1s like Avalanche has moved to stablecoins or back to Bitcoin. The 70% spike in Iranian outflows is adding supply shocks that complicate flow modeling for these specific chains. Without futures support, this drop is a liquidity grab, not a value entry point.
I would add a risk layer here. The broader market context is misleadingly calm. The SIBO VIX is sitting at 17.05, which suggests traditional equity markets are complacent. But crypto is decoupling completely. This idiosyncratic liquidity crisis means we cannot rely on traditional macro hedges. Holding Avalanche in this environment is mathematically equivalent to catching a falling knife, because the volatility regime has shifted from mean reverting to trend following downside.
Moving to Bitcoin, the anchor. Bitcoin is at $65,150, down 1.2%.
Bitcoin is holding steady, but only because it is absorbing all the selling pressure from the altcoin complex. The drop in futures demand to 2024 lows is the key variable here. Usually, low funding rates or low open interest can precede a squeeze, but in this case, it reflects a retreat of institutional participation. They are exiting or hedging aggressively, removing the key source of upward price support.
The sentiment data reinforces this caution. Retail investors are likely trying to buy the dip given the extreme fear, but the rising 7-day trend in the fear index suggests that retail is getting caught on the wrong side. The psychological distress is intensifying. Buyers are passive, sellers are aggressive. The market is prioritizing capital preservation over accumulation.
Visually, Bitcoin is failing to push higher despite the broader market cap contraction. It is acting as a drag on the entire universe. If Bitcoin breaks below the consolidation zone, the transmission of weakness to the rest of the market will be immediate and violent.
Now, Ethereum. Ethereum is at $1,882.17, down 2.4%.
Here is where the regulatory risk becomes tangible. The U.S. Senate housing bill, including a CBDC ban, is creating uncertainty for Ethereum. Even if the intent is to protect privacy, the market is pricing in regulatory overreach and operational hurdles for stablecoin issuers and solutions. Ethereum is bleeding out faster than Bitcoin precisely because it carries this regulatory baggage. At 1,882, it is underperforming the anchor asset, signaling that smart money is avoiding Ethereum exposure until the legal landscape clarifies.
The sentiment impact is clear. Ethereum holders are feeling the pinch harder than Bitcoin holders. The contraction in Ethereum dominance to 9.86% shows that confidence in the ecosystem is waning relative to Bitcoin. In an extreme fear regime, regulatory headlines trigger immediate sell-offs regardless of long-term utility. The market is not pricing in policy nuance. It is pricing in panic.
Technically, Ethereum is showing relative weakness against Bitcoin. While not crashing like Avalanche, the failure to maintain relative strength suggests that any bounce in Bitcoin will not automatically lift Ethereum. The chart pattern is weakening, mirroring the broader risk-off rotation.
Let's look at the outliers. Near Protocol is up 1.1%, making it the only gainer among major caps. Meanwhile, Solana is down 2.3% at $76.15.
Near isolation is interesting. It might be reflecting niche capital rotation or specific protocol updates, but in a liquidity vacuum, isolated strength is fragile. If near fails to hold above $1.89, that last pocket of speculative conviction evaporates, dragging the whole altcoin complex down.
On Solana, the 2.3% drop to $76.15 fits the broader high beta decay. Solana is being liquidated alongside the other smart contract platforms. There is no divergence here. It is following the leadership of the sell-off.
Finally, let's address the meme coin sector and the broader macro implications. Dogecoin is down 4.4% to 6 cents and 95 mils. FIL is down 4.8%. The meme sector is being purged fastest. Dogecoin at 7 cents is seeing accelerated outflows. This confirms that speculative liquidity is draining out of the ecosystem entirely. When fear is this high, the fun assets are the first to go. This is a clear signal that risk appetite is near zero.
And we cannot ignore the geopolitical tail risk. The Iranian crypto outflows spiking 700% is a massive red flag. It indicates that crypto is being used as a sanction evasion tool, which invites increased regulatory scrutiny and potentially exchange delistings in compliant jurisdictions. This adds a non-market-driven supply shock that makes flow modeling unreliable. It is a wild card that keeps volatility elevated.
To synthesize, Grid has identified broken technicals on Avalanche and Dogecoin. CIPHER has highlighted the collapse in futures demand driving the liquidity vacuum. And SPECTER has warned that geopolitical and regulatory risks are creating an idiosyncratic crisis, separate from traditional markets. The consensus is bearish for alts, neutral to negative for Bitcoin, and cautious for Ethereum due to regulatory headwinds.
So, what is the takeaway for the trading desk today?
First, respect the liquidity vacuum. Total volume is 61.8 billion, but with futures demand at 2024 lows, there is no leveraged fuel to drive a sustained rally. Second, monitor Bitcoin's ability to hold 65,000. If Bitcoin loses that support, the altcoin decay accelerates. Third, avoid catching the falling knives on Avalanche and Dogecoin until volume contracts and price stabilizes. The risk/reward is heavily skewed to the downside.
Key takeaways: Bitcoin dominance is rising as a flight to safety. Altcoins are experiencing a structural unwind of leverage, and regulatory/geopolitical headlines are adding friction to an already thin market. Watch for follow-through on Core Scientific's earnings reaction and the PayPay IPO filing details, which may influence BNB correlation. But for now, the data shows a market in defense mode. Thanks for listening to ShadowQuant Crypto Edition. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Crypto Edition. Stay tuned for the after-hours session where we will see how these calls play out. Until then, trade safe.